Holy smokes, Chinese stocks are up almost 7% following their lowest close since 2005. On top of that, we've got even more rumors coming out from what's now being dubbed NikkeiLeaks. That's because there's this guy, Nick T, at the Wall Street Journal who seems to be sitting in the back pocket of the Federal Reserve and happens to get text message leaks from the Fed, and boy, we got another one today. Another one. Well, folks, the reason Chinese stocks are up and we're seeing some green in our indices has in part to do with unverified social media posts circulating that a committee is potentially being formed in China to assess scenarios to exit COVID-0. Now, that would be remarkable since after the Chinese Congress that we just had, the National Congress, we were expecting some kind of softening to COVID-0, but we got nothing. All we got was a soft exit for Hu Jintao. The Chinese foreign minister did hear about these rumors this morning and said that he was not aware of such a committee being formed, so stocks pulled back slightly after that, but people think, there could be some truth to this. It could be time to exit COVID-0. And boy, that would be great for Chinese stocks. But we also have to react to this article from NikkeiLeaks because not only are Chinese stocks doing well, but indices are green in the United States and treasuries, like the 10-year, are down to 3.932 at the time of this recording. Let's go ahead and jump in together into this new NikkeiLeaks article that just came out. All right, here we go. Fed meeting to focus on interest rates coming path. Now, keep in mind, over the last few NikkeiLeaks reports, we started with the first report 2 Fridays ago, which said the Fed is worried about creating a stock market rally because that would loosen financial conditions, and they don't want that. In the next report, which was yesterday, they talked about this idea that we could see the terminal rate for the Federal Reserve, instead of ending at 4.6, end at 5.25 or 5.5%. Well, apparently that wasn't blunt enough, so now they're getting a little bit more aggressive. And so here's the article. Some officials recently began signaling their desire to start reducing the size of increases after this week. In other words, we're expecting a 75 basis point hike here on November 2nd, tomorrow, which 75 BP hikes are strong. We haven't had those since 1994, and then again, of course, when we started just 3 months ago. And that's because Fed officials are worried about creating an unnecessarily sharp slowdown. They're trying to cool the economy, not throw it into a deep freeze, they say in this article. So they do need to slow the pace, keeping in mind that 50 basis points is still strong, and that the December meeting would be a natural time to slow that pace of increases, because at the same time, we're going to be getting a new SEP. That stands for Summary of Economic Projections. We will not be getting a new Summary of Economic Projections in the November meeting. So hence the December meeting could be the perfect time to say, all right, we're going to go to 50. And now that we're going to 50, let's raise that 4.6% terminal rate to say 5.25 or something else. See, here you get arguments in this article that going faster is now about raising that terminal rate rather than how big the rate hike is every single time. Now, what's interesting is a message from our sponsor. You know, some of you might not know, but I'm not a landlord anymore, and I'm a little disappointed about this because, I sold 85% of my properties, all the ones with tenants in it, and I'm not a landlord anymore. So now when people are like, but hey, Kevin, the New York Times has you featured as a landlord influencer, but you're not actually a landlord, like, what happened? I thought you were the landlord to go to with questions about landlording online. And I have to say, I was so disappointed. I thought, you know what? Maybe there's a way I could become a landlord again. And so what we did is we got ourselves 1 square foot of land in Scotland. And now we're technically lords of the land again. We have 1 square foot of dedicated land on a private estate in Scotland. We have an official certificate to go with it. And I'll show you that certificate, and I'm gonna take you into this special spot where my certificate is. See, my certificate features a unique plot number, so that way I can always geolocate my exact location. And the company that plots these plots and sells these plots plants a tree with every single order. So if you want to be a landlord, consider using the link down below, and you can officially change your name to Lord or Lady, like on your plane tickets and credit cards. There's some things you can't put it on, like passports and driver's license, sadly, but I'm officially a lord again. So you can now go to establishedtitles.com/meetkevin to get your last minute gift for someone else. You get 10% off when you use the Meet Kevin coupon code, or you go to establishedtitles.com/meetkevin. What's really cool is Established Titles is running a large sale right now that's unique to this moment in time. So make sure you use that code MEETKEVIN to take advantage of that sale. And quite frankly, it's kind of cool to officially say I'm a landlord again. By the way, Established Titles told me the first 200 people purchasing a title pack using my link down below will effectively be next to my plot within a few minutes of walking. Depending on how many of you want to become a lord or lady, we can build our own little channel named Kingdom 93. Show you the certificate. Here it is, my certificate in my new podcast set. Don't tell anyone yet, but we are gonna hang this up so that way I'm officially a landlord in my podcast set. Let's go. You get this, which is clearly from the Wall Street Journal and not at all from the Federal Reserve, but you get these comments here about how markets are split on whether or not we're going to get a 75 or a 50 in December, which is okay. It's okay for markets to be somewhat split, but usually when the market is split, the Fed likes to guide them into one direction, and I think really what they're doing here is guiding to the 50 basis point hike for December. And they're suggesting that, hey, like some of their work is starting to actually function. Domestic demand has slowed. The housing market is entering a sharp slowdown. But on the other hand, you still have a strong jobs market. There's still strong consumer demand, and pricing pressures are still elevated. And so now, after we get this November meeting, remember I've talked about this, what are we going to get? We're going to get 2 CPI reports, and we're going to get 2 jobs reports. So it's not just 2 more months of economic data, it's that this November 2nd meeting has like no data. The next set of data comes out on November 4th, which is the jobs report, which is quite interesting. That, they set the schedule this early for the November meeting, but oh well. Now, they do talk about this. While the Fed could slow in December, this I think is a red flag here. They could still get to 6% in our forecast. Now, I think this is the potentially Nikki Leaks here being a little unnecessarily aggressive, but it is possible that the Fed does end up hiking to 5.25% to 6%. That doesn't mean we can't still have an end of the year rally. And I want to be very clear about that, because some people are like, hey, Kevin, you made a video talking about an end of the year rally, but why would you do that if you think the Fed funds rate is going to increase to higher levels? And I want to distinguish that. I think we can have a rally and we can have a very aggressive Fed next year, as long as we see an endpoint to when the Fed is actually going to hit some form of terminal rate. And I think markets are already convinced that 4.6% isn't going to be where we're going to stop. We're going to stop in excess of 5, maybe 5.25%. Maybe we'll get to 5.5, 5.75%. Do I really think we're going to get to 6? No, but then again, a year ago, I don't think anybody thought we would have gotten to 4. Now, I do think this is interesting. Many investors this year have been eager to interpret signs of a less aggressive rate rise pace as a sign that it's a pause, or that a pause in increases is not far off. But a sustained market rally risks undoing the Fed's work on the economy. In other words, again, this is the second time in a row, including if we go back to yesterday's article, this one, cash-rich consumers could mean higher interest rates for longer. In this article, actually, and the first one, insofar all three parts of the Nikki Leaks articles, we are hearing basically the Fed tell us that if we have a rally or if we have strong earnings, then that's actually not what we want. We just this morning had Uber earnings, which even though they were unprofitable again, we saw numbers that actually beat. So you're getting earnings that are beating. And now you've got the Fed kind of trying to thread this needle of, we don't really want your stocks to go up because we kind of want y'all to suffer. And so I guess we'll just have to keep writing these articles. Although so far, these articles are just helping the market go up, not down. So I'm not sure it's quite achieving what the Fed's goal is. But it's interesting to see the Fed say, hey, you know what? Look, now it's not about how large, it's about how long we can last, okay? How long can we keep the hikes going? It's not about how large every single move is. Okay, Fed, okay. So far, I think there's a lot of optimism in markets right now. That's not to say I want to sit here and call bottom. It's not to say that I'm going to mislead you and say I'm shorting the market, because I'm not. I'm pretty much all in on this sucker. The only short I got is $1 short, and boy, that has been a tough position. I still think it's going to do well eventually, but damn, that's been a tough position. Anyway, thank you so much for watching. Check out the sponsor for the video, and folks, we'll see you in the next one. Goodbye.